We have already discussed the inner workings of a bank in our previous video, also explaining how the banking system is such a fundamental force impacting our economy. Now, are there any other type of institutions which have a comparable impact? Yes. After banks, insurance companies whose products allow us to manage our day-to-day risk are phenomenally important. An insurance policy is a contract where one party, the insurer, receives a premium from another party, the policyholder, who is indemnified if a specific contingency arises. That contingency might be your car breaking down, your house catching fire, or you, I hope not, getting diagnosed with a debilitating disease. The key function of an insurer is the pooling of risks. It therefore serves an important social role in mitigating risks for both individuals and businesses. So we thought it's worthwhile to understand how an insurance company makes its money. The typical insurance cycle can be summarized in 3 stages. Stage 1 comprises of an insurer receiving the premium paid for the contract while incurring some acquisition costs, such as the commission paid to the broker, and administrative expenses, such as billing. The premium received is immediately invested into financial assets. Stage 2 is when the investments made during stage 1 generates investment income. In terms of costs, this phase only sees some ongoing administrative expenses. Finally, the insurer will pay the claims on the contracts for which they arise and will bring through profit and loss the positive or negative difference between the estimated and the actual claims. Given the described insurance cycle, it is possible to identify 2 categories of profits for an insurer. Number 1 is the technical or underwriting profit. This is based on the premiums received and the claims and operating costs paid out in return. Number 2 is the investment profits, which is essentially the returns that you make on the invested premiums. As an example, say you're Mr. Sharma, who insures his car for 1 year by paying a premium of Rs 20,000. Now, assume your insurance company has received premiums from 99 other customers, each paying, for argument's sake, Rs 20,000. Hence, total premiums collected equals Rs 20,000 times 100 equals Rs 20 lakhs. Now, the insurance company could have incurred some upfront costs to acquire these customers. For example, commissions paid to brokers. Let's assume that is 20% or Rs 4 lakh of the premiums, leading to actual premiums received of Rs 20 lakhs minus Rs 4 lakhs equals Rs 16 lakhs. Now the insurance company will immediately invest these 16 lakh rupees into various financial assets such as corporate and government securities. Let's assume the insurance company makes an effective return of 15%, implying an investment income of 15% times 16 lakhs equals 2.4 lakhs. Now meanwhile, let's assume 15 of the 100 customers actually filed for claims. Each claim was worth Rs 1 lakh during the year, amounting to 15 lakhs in total. Assuming there are no other operating costs, while in the real life scenario you will obviously have additional costs such as for claims management, employees, etc. But for simplicity's sake, let's assume there are no other operating costs. Now in this case, the insurer's profits would include the original investment income of 2.4 lakhs, the total premiums received of 16 lakhs after paying the brokers, minus the claims payout of Rs 15 lakhs, which equals to a profit of 3.4 lakhs. Not bad, huh? Hence, the insurance company's revenue model is based on the law of large numbers. Essentially, that means that the average of the results obtained from a large number of trials will move closer to the expected result as more and more trials are conducted. In this case, the insurance company rightly priced that 15% of its policy holders will end up getting involved in accidents and file for claims. Hope you enjoyed this video and understand how an insurance company works a bit better. Please comment and subscribe to Transfin for receiving rich original news content from the world of business, finance, and our economy. Have a great day.